Hi, I'm Jimmy. In this video, we're going to walk through a quick review of where the US economy stands. Our goal with this video is to see if we can use different economic indicators to try to objectively gauge where the economy stands today. And then we want to use that information to see if we can answer the question, should we invest now or wait for another stock market crash? Okay, let's jump right in because I've got a few additional economic indicators that I want to use from the last time that we did this video. So our first economic indicator is the Baltic Dry Index. And just so we're all on the same page, what this index does is it measures the cost of shipping raw materials. And it measures the cost of shipping goods from 3 different ship sizes. Now, this index tracks the price of shipping raw materials. So this is very important to the manufacturing industry, which is ultimately very important to the broader economy. So we're really looking at the broader trend here. So for me, from the lows are quite obvious that happened when the global economy shut down thanks to the coronavirus. Then as things began to open up, well, the cost of shipping at least increased somewhat as more demand came back online. And then, well, we saw another pullback recently, and I'm not too surprised by this most recent pullback here because I would expect for there to be some pent-up demand from the shutdown, and then you saw a pop in prices, and then things began to level off. So does this point belong to the bulls or the bears? Well, last month we gave this point to the bulls because we could easily make the case that things were starting to run higher. But I think it makes more sense in the light of this most recent pullback. I think it makes sense to at least give both bulls and bears a point. So we're going to go neutral with this particular one. So when we switch over to the scorecard, they both get a point, and that only happens once or twice out of the economic indicators that we use. Okay, now we shift over to the ISM Manufacturing Index, which is actually closely tied to the Baltic Dry Index. This economic indicator is supposed to measure the level of growth in the manufacturing sector within the United States. So anything above 50 implies growth in manufacturing. Anything below 50 implies that the manufacturing sector is shrinking. So clearly, we just had a nice jump above 50, which is a sign of strength. Now, it's possible that this is just a head fake, sort of like we had right here. But for now, I think this seems like a positive sign for the overall economy. Manufacturing's been a weight dragging down the economy for a little while, even before the coronavirus. So in this case, I think it makes sense to give this point to the bulls. So jumping back to the scorecard, they get a point. So we're not looking too bad so far. Now we shift over to initial jobless claims. Okay, so just looking at this chart or listening to any of the news, we could tell that this has been quite terrible. And the thing that actually concerns me the most about this is right here. So we can explain why this jump happened, and then the steeper drop off, well, that was at least somewhat expected as things were sorting themselves out. But it is concerning to me that when the number of jobs being lost on a weekly basis is this high and even inching slightly higher. So either way, this is going to be a point for the bears. But before we go ahead to the scorecard and mark that one down, let's shift over to unemployment. This is another angle on the job situation. And we can see right off the bat that this is going to be a point for the bears as well, since anytime there's 11% unemployment, well, that's not really a good thing for the economy. Now, it's still possible that a vaccine hits the market, or we get some positive development with the coronavirus, or at least anything from the pandemic perspective, and clearly that would be a good thing and could drastically improve this number quickly, and the jobless claims number. But for now, we have to add these 2 points for the bears. Now, if we were adding weights to each of these indicators, we're not, just for the case of simplicity, but if we were, I would actually weigh the jobless claims as a more relevant number than the unemployment situation, since unemployment is a lagging indicator, or usually it's a lagging indicator, and those numbers only come out once a month, while the jobless numbers come out weekly, so they're a bit more timely. We could see it in a bit more real time. Okay, either way, now we're moving on to housing starts. Now, this economic indicator tracks the number of new houses being built. And once again, the initial pullback, well, that makes a lot of sense thanks to the coronavirus. And I'm glad to see that we saw a jump in the most recent number higher, which could be a good thing. But Are we quite ready to call this a bullish move? Of course, the jump higher is better, but it's possible that this monthly economic indicator turns negative next month. So from a scorecard perspective, I think it might be a bit too soon to say that this is a point for the bulls. I think it makes more sense to once again go neutral with this one and call it a point for the bulls and the bears. Okay, now we shift over to a very important indicator in my mind. This is consumer confidence. And it's my belief that the stock market before the coronavirus, especially on the tail end of the very long bull run that the economy had and the stock market had, was that good because of this high consumer confidence level. We can't forget that in this time period up here, well, the Fed had begun to increase interest rates, they had begun reducing their balance sheet, and the stock market continued to move higher, despite that those are two things that, in theory, could slow the stock market down. And I believe that this was largely due to the consumer confidence levels. So looking at today, or even going forward, well, clearly this is a bad thing. And what happens when, well, let me get rid of that line. Now, what happens when now that consumer confidence is ticked back lower? I saw it start to tick higher. This is the downfall to having a monthly indicator, but it started to tick higher, but then it ticked lower again. The question now is what happens going forward? Do we get a turn lower or do we get a turn higher? Either way, it makes sense to give this point to the bears, since clearly this is a negative thing for the economy. So over on our scorecard, well, we've got yet another point for the bears. Okay, next up, we've got a new economic indicator that I haven't used yet. I haven't used in previous months. And that's because it's a tricky indicator, because it's not really an indicator. And that is the Federal Reserve and the things that they're doing to influence the stock market and investors. So let's look at one of the Federal Reserve's biggest tools, and that is the Fed funds rate. And just so we're all on the same page, the Fed funds rate is the interest rate that the Federal Reserve sets where banks can borrow and lend to each other on an overnight basis. So just to do a quick summary, every night, each bank must hold a certain amount of cash on hand to meet various standards. But so much activity happens during the day that sometimes banks don't have enough cash and other banks have too much cash. So the bank that's short on cash might go ahead and borrow cash from the bank that has too much cash. They borrow that at a predefined interest rate. Or it's really a negotiated interest rate, but it's an overnight rate that the Federal Reserve sets. Oh yeah, if the bank that has the extra cash doesn't want to lend the money, well, the other bank that needs the money can also borrow it from the Federal Reserve if they need to. Once again, at the same rate. So the Fed funds rate is the rate paid by banks to each other, once again, on an overnight basis. Now, we may have heard that the Fed funds rate was set to 0, and that's very true. But the Fed doesn't actually set an exact interest rate. Technically, they set a range of interest rates. The current low end of that range, they call it the lower bound, is 0%, which is where all the news came from. The high end is 0.25%, so 0.25% or 1/4%. So if we were to zoom into this chart just a little bit, just to this time period here, well, we can see that once the Fed set the rate to 0 in this time period, well, the rate has actually moved around slightly within that range. Last I checked, it was trading at about 10 basis points. 10 basis points is 1/10 of 1%. So 0.1%. Now, I just wanted to point out how this works. Either way, switching back to the long-term chart now, and I'm actually going to make a more in-depth video on this exact topic because I think that this deserves a lot of investors' attention, or at least some attention. But looking at just as one side of what the Fed did in reaction to the coronavirus, which, by the way, is one of the main reasons that the stock market has rallied like it has. Well, the Fed's reaction as far as interest rates go wasn't terribly uncalled for. As I mentioned before, leading up to the coronavirus, the Fed, starting in 2015, was actually increasing interest rates. And the economy began to hesitate a bit, specifically in manufacturing, right around this level. And then the coronavirus hits, the economy goes into a recession. That's actually what this red line indicates. And of course, as of the creating of this video, we're still in a recession. And we'll touch on GDP in a second. But the point I want to make with this chart is that what the Fed did here is not terribly new. It's not terribly different than they've done in previous recessions, or at least the past 2 recessions. When we pull up the tech bubble, well, we can see that that recession played out from an interest rate perspective in almost exactly the same way. And then when we throw up the financial crisis, well, once again, it's a very similar story. A decline in interest rates as the economy approached the recession. As the economy was weakening, they started lowering rates, and then they lowered them much more drastically as the economy got deeper into the recession. Now, I could go on about the Fed for a whole video. That's exactly what we're going to do very soon. But I don't think what they did here was terribly uncalled for. I think it was actually an appropriate reaction. Quick side note, what they're doing with the repo markets and what they're doing with buying debt, that's a whole different story, but we'll get into that in the other video. But for now, just for the sake of recognizing that the Fed's involvement is it's not clearly a good thing or a bad thing. I do think it's in the gray area. So I think it makes sense for us right now to put this down as a neutral point, since at least until we have the whole picture. So when we do the next video on the Federal Reserve and how they're impacting the market, we can adjust things then. Okay, now we shift over to GDP. Now, obviously, when we look at what happens with GDP, especially in this most recent time period, well, it's a tragedy. So without a doubt, this is going to be a point for the bears. But, and I think that this is very important, I do think that this number is not being presented in the right light. Now, I'm not suggesting it's not bad. It is, it's terrible, but it is a quarterly number. And as I've mentioned before, quarterly numbers are presented on an annualized basis. And in the case of GDP, this number is also adjusted for seasonality. So if we look at this chart and we say, wow, US GDP just lost a third of the value of the economy in a single quarter, well, that's not actually true. They lost a little less than 10% in a single quarter, which is a bad thing. But the reason that they present it like this, more than 30%, 33 or so percent, the reason that they present it like this is that if the second quarter repeated itself 3 more times, so you had 4 quarters of that, after adjusting for seasonality, it would be down 33%. But it was only 1 quarter, so it's not really 33%. Still terrible, but not 33%. Either way, this is a point for the bears and a bad thing for the overall economy. But I just wanted to point out what those numbers really mean. Okay, now to try to get to our starting question, do we invest now or wait for a stock market crash? Well, on a personal basis, I'm sticking with opportunistic investing. I'm looking for stocks that appear cheap and then jumping in those stocks based on the research. Intel is a good example of that. I haven't gotten involved in that one just yet. I plan on doing that in the near future. I just created a video on it if you're curious. I'll leave a link in the description below. And then the other side of investing, or one of the sides of investing, one of the angles of investing, is dollar cost averaging, which is, it consists of putting the same amount of money in the market or stocks or bonds or ETFs or whatever it is on a consistent schedule. No matter what the stock market is doing, you're consistently investing X every week or every month or every quarter, whatever it is. And if that's what we're doing, I think it makes a ton of sense to ignore what is happening with the stock market and just continue to do that. And then if we're speculating, well, I actually think it makes more sense to wait for the stock market to crash again, because it is very possible that the coronavirus doesn't get handled the way we think, and you could see a drastic pullback in the stock market, if nothing else, to correct some of the overvaluing that's happening because of the Fed's involvement. But if you're curious to learn more about this type of thing, I actually did a video where I looked at some more unique economic indicators. For example, OpenTable, the app, puts out an economic indicator on how many people are eating out to restaurants. Or there's another company that puts out information on how many people are traveling on public transportation. If you're curious, perhaps that could be a good next video for you to watch. I've got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.